I think the markets are as ridiculous pricing in one cut as they were pricing at 9 back in September. But I realize that a lot of this is just, risk management because we don't know what Trump is going to do or not do. So basically, I tipped my hat to the bulls and I said, it could well be that what's happened here is that U.S. equity investors who have been long and right, that they probably have lengthened their investment horizon. And I guess people think that Canada will just sit down and take it. Once the tariff is on, the trade war is on. You can use the trade tariff as a bargaining chip, but once it's done, Canada will hit back. I am bullish on Treasuries because I think that the economy is going to be weak. I don't think Trump is going to get through the tax goodies that he wants. I do not know what people are looking at. They seem to think that Trump has a magic wand.
Hi, everyone. I'm Maggie Lake, and today I'm talking markets with David Rosenberg, founder and president of Rosenberg Research. Hi, David. It's great to see you again.
You too, Maggie. Happy New Year to you.
Same. And I feel like we're going to kind of get shot out of a cannon. I don't know. There's been a lot happening, even though we're just getting started, the beginning of the trading year. But just give us a sort of reset. How are you feeling as you look ahead to 2025? What do you most focus on right now?
Well, I think that we're all focused on how you navigate your economic forecast and your investment portfolio in a complete bog of uncertainty. So that's why I think it's apropos. It's the Chinese year of the wooden snake, which only happens every 60 years, which is apropos because I think that we're into a bog of uncertainty that we probably haven't seen in 60 years. So I think that, that's the one thing I will say, and I'm going to asterisk and caveat everything I'm going to say, and every forecaster should be humble enough to realize that the error term around any forecast for this year is much wider than it's been in the past, and we have to acknowledge that.
Yeah, you've been doing that in your notes. Really, even when we spoke back in October, you could sort of see that you were really doing some soul searching and kind of sort of rebooting and figuring out, whether you need to change the way you're looking at things, and you've been kind of cataloging that in your notes.
Yeah.
So are you even a bear anymore? Do we even call you that? Everyone, we know famously jokes that you're a perma bear. I know you think you're not.
Well, remember, the title of the report they're referring to was The Lament of a Bear. So I didn't change the title to, entering into the bull ring. Okay. It was an attempt, and I think, we should all do that in this mugs game of a business called economic and market forecasting, is to do an accounting. I guess the end of the year is always a good time to do that. And where you missed a big call, which I did in the equity market, the U.S. equity market at least, to own up to it. I never hide behind a rock. I teach all my staff, that's not what you do. You have to own up to your bad calls and explain what you missed and whether or not you're going to change course, and if you're not, why. And in that report, I didn't offer any mea culpa, and I said that's explicitly, and I didn't throw in any towel. It was really more an exercise in responsibility and accountability in terms of assessing, what went wrong with the call. In other words, what is the market saying, or what is the market saying that I wasn't saying? And so it's more, what do you do? What do you do, Maggie, when you're out of sync with a particular asset class, especially something as important as the S&P 500? And so what do is you do some introspection. And that's really what it was. It was my way of explaining what happened in terms of the divergence between what I saw and what the market did, and then why I'm not changing my opinion. So basically, I tipped my hat to the bulls and I said, look, it could well be that what's happened here is that U.S. equity investors who have been long and right, that they probably have lengthened their investment horizons, and that perhaps is a situation where 12-month trailing and 12-month forward multiples don't apply as much today as they do in a normal cycle. And when I say a normal cycle, I'm not talking about the uncertainty regarding, Trump's immigration and trade and fiscal policy. I'm talking about what happened with generative AI and this tremendous shift in the innovation curve. And of course, people came back and said to me, well, are you some Johnny come lately? And no, we've written a lot of reports on the AI mania. And I even had a panel last year in my webcast with some AI
you and I
experts.
talked about it at a conference. Yeah,
that's right. And I probably just underestimated the willingness and the ability of the market to really price in, a whole lot of growth. I would be the first to say that, there are going to be future productivity benefits and the implications for corporate cost reduction and profitability coming out of this inflection point in the technology curve. And I'd be the first to say that, but it's really more about the magnitude.
Mm-hmm.
So, what's happened is that, and this is what I explained in my report, was that we went to a situation where the market had gone ahead and effectively discounted over the next 5 years. So I'm willing to go beyond just 12-month trailing, 12-month forward, and willing to acknowledge that markets have taken a longer-term view on this technology revolution. And what they've done is taken the 5-year future EPS growth estimate all the way up to 20%. So the market is telling you that it expects 20% earnings growth per year for the next half decade, which, by the way, isn't impossible. It's happened 5% of the time in the past century, but it is a 1 in 20 event. And the last time it happened, by the way, was during the internet wave in the mid to late 1990s. What's hard to assess is, are we in 1996, are we in 1997, or are we in 98 or 99? But historically, over 5-year intervals, because profit growth is a mean reverting series, you tend to average around 7% to 8% per year on a 5-year CAGR, compound annualized growth rate and earnings. And we're about triple that right now in terms of what is embedded. So I was just decided, I'm not going to tell people what to do. I'm going to tell people, this is what the market is telling you it expects. This is the embedded valuation on a 5-year basis, not 1 year, not 2 years, 5-year basis. I have people say to me, I think that AI is going to be so powerful that we're going to get 30% earnings growth per year for the next 5 years, to which I say, well, then this market is for you.
Yeah.
And then when people say, I didn't realize that so much long-term growth was priced in, I'm more comfortable with 10 to 15%, and even that's strong, to which I say, well, maybe you want to either, take chips off the table or protect your portfolio in different ways from the downside, given that there might be too much priced in. So that was really what I did was give to the client base what the market is telling you, and then you decide whether or not you agree or disagree with the market. For example, something else was, what does it mean when the equity risk premium is a 0? It means that the investors are treating the equity market as a riskless asset. It's putting the equity market on the same risk level as the Treasury bill market. Well, of course, Treasury bills have no duration risk. They have no capital risk. But the markets are telling you, when the ERP is 0, that the equity market has become a riskless asset class. Now, look, if you are comfortable with that, if you're comfortable with the view that the collection of companies in the S&P 500, the collection of stocks that basically become 0 beta, if you believe that, then this market is for you. If you believe that we're going to have 20% earnings growth for the next 5 years, average annual, then this market is perfectly priced for you. This market is for you, not for me, but for you. So what I tried to do was just diligently and eloquently, in a cogent way, try to outline what it is the market is telling you. I did not believe for a second that we would get to this stage. I knew that AI would be powerful. I didn't know it was going to be causing investors to price in the same sort of growth rates that we had back in the mid to late 1990s. Now, that didn't last, but generative AI is a new, very powerful application. and the chips needed for it, and very powerful, no doubt about it. But it is not the internet. I mean, the internet, it's a product of the internet like everything else is. The internet was like electricity. But anyway, I guess I just basically underestimated, Bob Farrell's rule number 4, which is that exponentially rising markets go further than you think.
Mhm.
And this market went further than I thought. But the second part of Bob Farrell's rule number 4 is that these sort of markets don't end up correcting by going sideways.
Yeah. Yeah. So at some point, and this is the battle that a lot of people are, I think, going through, including, listen, everyone is, I think you can say almost everyone has some exposure to Mag 7, right? It's been the whole market. And I think a lot of people are trying to figure out, is this going to end badly? Have we pulled forward all that growth? And how does this play out, and what happens from here? So how do you reconcile this idea now? Okay, maybe this isn't irrational if the sort of best case scenario plays out with AI, and it is this just magical transformation, versus we're out over our skis already. How do you make a determination of that? Or how are you telling people to try to approach that question? Because it's almost impossible to know, right?
Well, we're talking about stocks. We're not talking about companies. These companies have real business models. They have real growth and real growth prospects. NVIDIA is not a .com, but these are great companies. But Cisco was a great company. Intel was a great company. IBM was a great company. Dell was a great company. Intel was a great company. And they all got caught up in that whole internet mania. I mean, we call it a .com. It was a broadly based rally, what we used to call TMT back then, technology,
huge Canadian
media, and
companies,
telecom.
Lucent, Nortel.
Right. And so, but some of those weren't great companies, the ones that went under. But companies like Cisco and Microsoft, these are bellwether technology giants with real business models. And they went down for the count and were in the penalty box for about a decade.
Right.
So we're not talking about companies, and who's going to argue that the internet was a game changer for everybody? Who's going to argue that? But it didn't prevent the markets from over-anticipating the growth that was going to happen. And then what happens is you have a reset. Now, at that point, you also had tremendous overcapacity being built up in fiber optics and telecom equipment and wiring and so on and so forth. And there's no evidence that that's happened just yet. But like I said before, we're building into a situation where the markets have discounted the growth already. And it's discounting already a 1 in 20 event. So as far as I'm concerned, it's probably, with no degree of certainty, because there's still so many unknowns. We don't even know how is AI even going to be regulated. However, I would say, broadly speaking, and don't forget this has had an impact throughout the entire stock market, because it's not just about AI and it's not just about the chips. It's had a spreading impact throughout the entire market because everybody is going to benefit from it. This is going to be a major element of cost reduction and productivity in the future. It's not just about the purveyors of AI technology. It's also about all the consumers of it, which will be everybody. So it's very broadly based. And I'm not going to say that every sector or every region, for that matter, shares the same dynamics when it comes to excessive valuation. My point was that if we can acknowledge that investors have lengthened their time horizon, yes, then we can look at future growth embedded in the stock market. And it's not just the Mag 7 stocks. The broad market has 20%. And this is important, Maggie, because everybody is buying index funds. All the 401ks are in these passive index funds. They're all linked to the S&P 500. So it's the overall index. And the overall index is priced for 20% earnings growth per year for the next 5 years. Like I said before, beauty is in the eye of the beholder. There's people that actually believe that's going to happen, to which I say, well, then you should be comfortable being in the stock market. You see, I'm not there. I don't believe that it's going to be that powerful, that earnings growth is going to be triple the historical norm over a 5-year period. So I just say that, the ship has sailed. What we're going to tell people, we're going to tell people to go long growth stocks and technology in late 99, early 2000. The ship sailed. There's no sense. What are you going to do? You're going to jump in front of the steamroller to chase nickels at this point? So, 100%. I did miss that call. I made other calls that worked out very well, actually taking on less risk-adjusted returns, what people should focus on. People ultimately grade you on your S&P 500 call. I'm not wed to the S&P 500, although a lot of my clients, that's their domain, that's their life. But I will say that no matter what metric you want to look at, the stock market is just too expensive. And, price is what you pay, and then it is value that what you end up getting. So if you want to take a look at a real valuation metric that looks at valuations over 10-year cycles, go to the CAPE, the Shiller cyclically adjusted price earnings multiple. And it's 37 right now. The last time we went into any year with a 37 multiple was 2022. Well, we know what happened next. Nobody anticipated a 30% drawdown that year in cyclical stocks. And before that, you got to go back to 2001. So we have a situation where looking at the CAPE, which is something that I look at, and it's not a market timing tool, but I'm not a market timer. Everybody thinks they can time the market. It's like hitting a hole-in-one in golf. Maybe if you're lucky, it'll happen once in your lifetime. But we are in the top 3% of valuations, and the CAPE goes back to 1921. There's no valuation metric that has that rich a time series. We're in the top 3%, Maggie. That is a 2.3 standard deviation. The only 2.3 standard deviations that I will ever invest in is in the other direction, when the S&P 500 price earnings multiple is like 8 back in the summer of 1982. So went back into history and found that if you have 5 and 10-year investment horizons, when the starting point is 37 on the CAPE multiple, the forward returns, and it's the only time when you're over 35 on the CAPE, it's the only tranche out of all the tranches where your future returns, 3-year, 5-year, 10-year, that are negative. Now, maybe that's not going to help you if you're thinking, what am I going to do next week or next month or next quarter? But there's a lot of pension funds and sovereign wealth funds and family offices that do have 5 and 10-year horizons.
Yeah, an awful lot of them.
When you have a 37, think about a 37 CAPE multiple. So no, I'm not going to invest this way in a 2+ standard deviation event. People can argue that, well, you could have said that last year, but last year the multiple was well below where it is today. Like, we're really in nosebleed territory, and there's a lot of growth priced in. And then we have to ask ourselves the question: why is Warren Buffett sitting on 30% cash, and he's being laughed at? He's being laughed at. Like he was laughed at back in the late 1990s when he was being called a Luddite and didn't understand technology. But he's never been at 30% cash before. And of course, the market is ripped in his face, just like it's ripped in my face. But both of us will be there and pick up the pieces because we're going to have the liquidity when that time comes. Of course, I think he'll move the market more than I will.
So let me ask you, David. So people, and I think there are a lot of people who share this concern, who've watched the gains and think, it feels like we're overextended, and I'm worried about my equity exposure. Let's talk about bonds for a moment, because traditionally that would be an asset class people would look to. But as we speak, U.S. bond yields are moving higher. What's happening with bonds? What are you seeing there?
It's all reflected in the shifting expectation of what the Fed's going to be doing. And what's happening right now is we are replaying what happened in the opening months of 2024. Now, if you remember, we peaked at 5% in the 10-year Treasury note yield back in October of 2023. And then the 10-year note went from 5%, and by late December of 2023, we were at 3.8%. We went down 120 basis points. And that was even in the face of a cumulative deficit at the time of over $500 billion. For all the people that say, well, it's all about fiscal policy. We had Treasury supply up the wazoo in that 3-month period. The 10-year note yield went down 120 basis points, October 2023 to December 2023. And what happened was that the Fed started talking dovishly, and the market started pricing in Fed rate cuts. Now, what happened was that exactly this time last year, we got a couple of hot CPI, PC deflator, core inflation prints. A lot of that was in health insurance and auto insurance, and the rents were not behaving very well. And Powell sort of pulled back publicly on his comfort level on disinflation. And so he caused the markets to price out the Fed. The markets went ahead and priced in a lot of Fed easing at the end of 2023, and they were forced by all the forward guidance out of the Fed to pull back that expectation. So the next thing you know, we go from the 3.8% low in the 10-year note in late December 2023, and by April 2024, this is only in a short span of 3 or 4 months, we're back to 4.7%, about where we are right now. So we went back up 90 basis points in short order. Did the world change in 3 months, Maggie? Did the world change? No. What changed was, what's the Fed going to do? And the market pulled back those easing expectations. So we're just reliving history, and not history of a long time ago, history of a year ago. So here we are, and we go all the way down to 3.65% of the 10-year note around the time of the September meeting of last year. And the Fed is talking dovishly, and the Fed's telling us they're going to be cutting rates 4 times this year. The market goes ahead and prices in 9 rate cuts. So it was a case of the markets front-running the Fed. And that was what happened back at the 3.65% lows on the 10-year Treasury yield last September. The markets are pricing in 9 rate cuts. 9 rate cuts for this year. And the Fed says, no, that's not going to happen. And they stuck with 4. And then at the December meeting, they went down to 2. And now the market is basically priced for about 1 rate cut and not fully priced in till September. So the most important determinant for yields out the curve is expectations of Fed policy. That's why the Fed matters. And in this case, it's not a matter of action, it's a matter of words, because the Fed's cut rates 100 basis points, since the jumbo cut in September, and yet yields have only gone up. And the average interest rate in the private sector, households and businesses, since the jumbo cut in September, the average interest rate in the private sector has gone up 70 basis points.
Yeah.
Normally, when the Fed cuts rates 100 basis points in, say, a 3 or 4 month span, the average interest rate in the private sector, which is what matters, goes down 70 basis points. This time around, they've gone up 70 basis points. People don't realize that there's actually been a considerable tightening in overall financial conditions when you consider what the average funding cost has been. People say the Fed's cut interest rates. For who? They've cut the funds rate. Who borrows the funds rate? You don't borrow the funds rate. I don't borrow the funds rate. Banks borrow the funds rate in the overnight market. What matters is what's the transmission mechanism from Fed policy to interest rates in the broader economy. They have gone up significantly, and that's probably one of the reasons why the stock market of late has been struggling, because let's face it, the S&P 500 first hit 6,000. People are still talking about the bull market as if it's present. But we hit 6,000 on the S&P 500 for the first time the week after the election. And we've just been fluttering around ever since, just range trading in a classic, what I think a technical analyst would say, a classic topping formation. So just to go back, I think that this is going to be, the last time we got to 4.7% on the 10-year note was in April of last year. And you threw in the towel on bonds then was a big mistake because we went down more than 100 basis points in the next 6 months. I think that the market's way overdid it, pricing in 9 cuts in September, and we swung the pendulum completely the other way by pricing in just 1 rate cut. Because there, in my opinion, not a snowball's chance in hell that the Fed can not bring the funds rate to even its estimate of neutral, which is around 3%. I'm lower than that. They will bring the funds rate to neutrality, the equilibrium rate, because I do believe that the unemployment rate will be drifting higher. I think it's going to get to 4.5% by March. Remember, the Fed's forecast for the end of the year is 4.4. And I think that there's going to be a lot of downward momentum on the inflation side, a lot of that coming from rents and the fact that the boom in insurance costs looks to be in the rearview mirror. The strong dollar and the action in commodity markets, broadly speaking. I mean, look at base metals and look at textiles. Oil is just basically a natural gas that have been range trading. I think that the surprise on inflation, because that's all I hear about is inflation angst. Once again, inflation anxiety. This debate will just not die down no matter what. But what people are ignoring is the fact we have a massive pipeline of rental supply coming into the market this year. And finally, we're starting to see the deflation in rents in real time starting to populate the CPI and the PC deflator. I think the surprises will be how far down inflation goes in the next year. So I think at a minimum, and this is just logic, that the Fed is going to get to neutral. And if they go down to 3% on the funds rate, and I think there's a chance it could go lower. I think the markets are as ridiculous pricing in 1 cut as they were pricing at 9 back in September. But I realize that a lot of this is just, risk management because we don't know what Trump is going to do or not do. But if we get down just to neutral, that's your base case, neutral. And how many easing cycles end with the funds rate above neutral? Not too many. Well, yield curve dynamics would take the 10-year no yield back to or below 4%. And from 460, 470 right now, you go down back to 4%. We were just there not too long ago. That's going to be more than a 10% total return for the 10-year Treasury. And that's actually my highest conviction call for the year.
You're bullish Treasuries.
Oh, I don't mind being out of consensus at all. And I'm naturally a contrarian investor. So yeah, I am bullish on Treasuries because I think that the economy is going to be weak. I don't think Trump is going to get through the tax goodies that he wants. I think that I do not know what people are looking at. They seem to think that Trump has a magic wand. He does in some respects. He could do it in trade policy and tariffs, whatever he wants. Of course, he could ignite a global trade war. I don't think other countries are going to sit idly by. He puts a 25% tariff on Canada. The Premier of Ontario said, go ahead and do that, President Trump, and we will cut off your electricity. Canada is a major exporter of electricity, natural gas, oil, and critical minerals to the United States, not well known. And I guess people think that Canada will just sit down and take it, but I don't think they will, because it's, once the tariff is on, the trade war is on. You can use the trade tariff as a bargaining chip, but once it's done, Canada will hit back. And I think there'll be a lot of industry pushback. So that leads us to the realm of the unknown, and maybe the Fed just sits back because there's going to be all sorts of different countervailing forces. In the interim, the recession nobody sees coming actually comes because this will be a significant shock. Obviously, more to Canada, but Canada is still an economy that's not the same size as the U.S., but it is the same size as California. And I can tell you that if California went into recession, the rest of the U.S. would go into recession. Okay, so there's all these spin-off effects and domino effects. Canada could actually have a detrimental impact on the U.S. economy. But who knows what Trump's going to do? We're so unpredictable that remains a big unknown. But I would say that I have a different inflation view than most others. I think there's a whole industry of people out there that just make it their business to forecast inflation. No, when we do a bottom-up and top-down view on inflation, the trend is going to be down. I think the Fed will be surprised. I think the Fed did its risk management. I think it deliberately implemented its own view of what tariffs are going to look like when they went from 2.2 to 2.5% on the core inflation forecast for the end of this year. I think we're going to be below 2%. on core inflation. And they're at 4.4 on the unemployment rate. I think we're going to be well above that by the end of the year. So, this is I live in a world, my industry is such that your assumptions drive your conclusions. So people say to me, you put 10 economists in a room, they all have different forecasts. What's going on? Well, because the assumptions are different. My assumption is the economy is going to be soft. My assumption is that inflation is going to go down. My forecast is that, my assumption is that the labor market is going to be loosening. Why would they be bearish on bonds? And if people say, well, we'll look at the fiscal side, well, with all due respect, when we had that monumental rally in the 10-year Treasury note yield from April of last year to September, and it was almost it was a 100 basis point meltdown in Treasury yields, we had $1 trillion cumulative fiscal deficit. Deficits have a 20% correlation with the direction of Treasury yields. It's not zero, but the direction of Fed policy has a 90% correlation with where Treasury yields are going. And that's actually been most of this story. Have five-year forwards moved since September? No. We've had hardly any movement whatsoever in 5 or 10-year inflation break-evens from the TIPS market. It's been all about the term premium as the markets reset to a more hawkish Fed. Now, the one thing I think that separates my view from everybody else is I don't think there's going to be fiscal stimulus this year. And I don't know what people are looking at. I mean, Mike Johnson barely got the gavel by a handful of votes. We have, what does he have? He's a one-seat majority in the House. Well, the bill's got to pass through the House. There's nothing. I mean, it could be called the bully pulpit in the Oval Office. That much is true. But you have more than 30 Freedom Caucus members who really don't give a damn, and they are not going to be signing on to any tax reduction bill absent spending restraint, which is where maybe Elon Musk is going to come into the picture. So I actually think that for the first time in a decade, what's going to make this year different is going to be that it's going to be a year of fiscal drag, not fiscal stimulus. So people don't realize that half the growth in the economy, the cycle, the American exceptionalism as it's called, half the growth has come directly and indirectly from Uncle Sam's generosity. Yeah, you can buy growth through 6% plus deficit GDP ratios, as long as that's going to last. But that's been the story. That's been the story for the American exceptionalism. America has always been exceptional. I love the fact that people had to take a phrase or take a narrative to fit to the price action. U.S. exceptionalism. When was the U.S. not exceptional? So it's basically what makes the U.S. economy with the illusion of stronger growth than everybody else in the world is everybody else in the world is running deficits of 3% of GDP. And America, the bastion of capitalism, is running deficits north of 6% of GDP. That's been the story. More. But I think that comes to an end this year.
So you said you think that you are different in that you think that Trump policies, both trade and fiscal, are actually potentially recessionary or a drag on growth, and instead of inflationary, because that's what everyone's worried about, right? Tariffs will be inflationary. Growth's going to be off the charts. That's going to be inflationary. They're going to spend like crazy. That's inflationary. You see it as having a dampening effect.
Well, firstly, you could have both. And that's when people will talk about the stagflation risk. I think that the tariffs will be an immediate price shock. The question is, who's going to bear the brunt? Will it be the foreign producer? Will it be the domestic importer? Will it be the consumer? The burden will be shared. And so it's a penalty.
Let me ask you a question. We're talking about treasuries relative to fiscal policy in the U.S., but people have been pointing out that it's not just the U.S., that global bond yields are rising. And Brent Donnelly, if any of you follow him, in his note this morning, pointed out that UK 30-year is at its high since 1998. Ours is high. Japan's 10-year is the highest since 2011. Why global? Is it a global situation that people are overly worried about inflation or getting the inflation story wrong? Is it concerns about debt? What are investors worried about? Why do we see this global rise in yields?
Well, I guess everywhere except for China. But just as in global, what's the leader in terms of global equity market sentiment is the S&P 500.
Yes.
Everybody keys off the S&P 500. When it's the global bond market, everybody keys off the 10-year Treasury.
Right. So it's influencing.
So it's really this all started with the radical shift in Fed expectations, and it'll end in the same way that it did last year. So I would say that who's there's the dog and the tail, but you know you have the ECB meetings, sure, you got the Bank of England meetings, you got the Bank of Canada meetings, the BOG meetings. Does anything stop like how they stop on FOMC meeting days? You can't. I could walk on a trading floor and I will not see at an ECB meeting. I'll walk by the trading floor, and on the TV I might not see Christine Lagarde. Okay, but I'll tell you something. On FOMC day, on the second day of the meeting, when Jay Powell is at the podium at 2:30 in the afternoon, everybody's TV is on. So this is part of the American exceptionalism. Everything keys off the S&P 500, and everything in fixed income keys off the 10-year traditional yield.
So if we see a situation where bond yields are falling, prices are rising, what does that mean for equities? Can equities also hang in the face of a recession? Will they pay more attention to the lower yields? That had been the case for a while. Or again, does the threat of recession put equities at risk, U.S. equities?
Well, waiting for the recession is like it's like a classic case of waiting for Godot. It hasn't happened, and nobody thinks it's going to happen. I almost feel like I'm back in 1989 and 2000 and 2007. We waited for the recession, didn't come. Let's move on, and then next thing you know, you get hit by a 2x4. No, if you have a recession, two things always happen: bond yields go down, and equity prices go down in every recession. You get earnings contraction, and you get because of the uncertainty that recessions engender, then you get a flight to safety, and you get a reduction in the demand for credit, and the Fed cuts interest rates. So Treasuries rally, equity prices go down. This happened in every single recession, 1981-82, 1990-91, 2001, 2002, 2008 and 09. They go down together. And then at some point, the clouds part, and the stock market gets to a ridiculously cheap point, and it's time to do the asset mix the other way. But recessions have that constant dynamic. There's one thing that is just a truism, that bond yields and equity prices go down together in recessions, but typically they will bottom before the recession ends.
So so even though you've sort of taken a look and sort of done an inventory about the equity situation and sort of changed how you're thinking about market expectations, it doesn't sound like you've changed your thoughts on the recession, even though it hasn't been showing up. Why is that? Because you don't think there'll be the fiscal spending that was in place before that prevented it? Why would you change your sort of thinking a little bit on stocks and what's driving expectations there, but not on the economy?
Because I think that interest rates in a credit-driven economy matter a lot. But the lags could be very long. The lags were very long in that cycle when I was at Mother Merrill, when everybody was saying, where's this recession already in 2007? But what got in the way of all the interest rate increases that Greenspan and Bernanke put into the system was that people were still managing to extract home equity to sustain their consumption. And they did that until they couldn't do it anymore. And this time around, it's been the excess savings file, which was much more powerful than I thought. That those stimulus checks, the $2 trillion that were given to anybody with a pulse back in the winter of 2021, that had a lingering impact. That money couldn't be spent all at once. And it was the gift that kept on giving. On top of that, it's been the fiscal stimulus. That's been the big story. I'm not going to say that absent the fiscal stimulus, we would have had a recession. But consider that GDP growth would have been closer to, say, 1 to 1.5% than 2.5 to 3%. We've had tremendous fiscal stimulus, and that thwarted my recession call. I didn't anticipate it. I did not anticipate for the second year in a row we'd have the deficit in excess of 6% of GDP. That's unbelievable. And so, again, where do your assumptions drive your forecast? I come back to that. My assumption was that we're not going to get the degree of fiscal stimulus that we got last year on the spending side. And this actually transcends just what happened with consumers still spending those excess savings, those pandemic savings. This was actually just the government sector. We're into the first 2 months of the fiscal year. The deficit is up 64%. The deficit up 64% in the first 2 months of the fiscal year. If left unchecked, the deficit is going to go from almost $2 trillion to almost $4 trillion. You don't think that the Freedom Caucus members, they don't see that? Spending is up. Program spending is up 20% year over year. And government revenues are down 7%.
Yeah.
That doesn't sound weird to you, Maggie, that government revenues are down 7%. Do you know why? Because of all the Biden subsidies. There's an EV subsidy here for consumers. There's a chip subsidy over here for manufacturers. So that's what we're talking about here. Yeah. We're talking about 6% deficit GDP ratios. Normally, you would run those to fight a recession. So it's interesting that apparently we don't have a recession. We have a fiscal policy that's implemented to fight a recession. Oh, but there's no recession. But a fiscal policy aimed at fighting a recession. So this is just a classic case of cognitive dissonance. But people don't know, what does the emperor look like disrobed? Once we start to get to a more sensible fiscal policy. Now, you're going to say, well, Donald Trump won't allow it to happen. To which I say, well, he doesn't control fiscal policy.
Say Congress rolls over and does allow it to happen. Does the bond market step in? I know you don't really buy into the bond vigilante, but could we?
I think that if Trump gets what he wants on fiscal, then my bond call is probably in trouble. My bond call is in trouble. But, I'm looking at it, trying to look at it rationally. I'm not looking at it emotionally. I'm not one of these people to say, well, these Republicans in Congress only got elected because of Donald Trump. They owe Donald Trump. Well, actually, Trump won the election fair and square, but with half the national vote. And he's operating. Let's look at this realistically and rationally. They got a one vote. They got one vote. They can't afford to lose more than one vote for any bill that's going to get through the House. There's no fiscal stimulus unless the House is going to approve it. And the House is replete with fiscal conservatives. And this is different. This is not 2016. Everybody was on board with taking the top marginal corporate tax rate from 35 to 21% and make America more competitive. We're going to take that down from 21 to 15%. But what are the offsets in terms of the restraint side? We don't even know, will all of the 2017 income tax cuts, will they all be extended beyond this year? Will they? Because don't forget that the CBO scoring is going to have something to say about that. Because if they aren't allowed to sunset, all these deficit projections in the future that you see about that causes your eyes to just bug out, they include those tax cuts from 2017 to sunset. So we're going to build a scenario where we're not going to have any of those. We see, this is what happens, is that what's supposed to be temporary is never temporary.
Right.
The tax increases in the 1930s and the 40s, to fight World War II, they stayed with us until Ronald Reagan won the election in 1980. Didn't come down until 1986. They stayed permanent. And then we have all this pandemic era spending to fight the pandemic. What do you know? the spending stays permanent. And we have tax cuts in 2017 that were designed to expire this year. No, 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 no. So it's temporary, becomes permanent. But you see, it's going to have a more pernicious impact. What's different for the typical fiscal hawk, and there's a lot of them in the House, is that back when Donald Trump won the election in 2016, the deficit to GDP ratio was 3%, not 6% plus. The debt to GDP ratio is 30 percentage points higher now than it was back then. And back then, interest costs on the debt were absorbing 8% of the revenue stream. It's doubled since then to 16% and going up. So this is not lost on fiscal conservatives. Donald Trump is not a fiscal conservative, but he does not control fiscal policy. He controls foreign policy. He controls trade policy. He's got executive order privileges, 100%. Does not control fiscal policy. And so I think, and there's no such thing as a sure thing. I can't say this is an ironclad guarantee, but it's just what I'm seeing with my own two eyes.
Yeah.
That no, I don't think that we're going to be getting through the tax relief that the markets have priced in. And so I think that will come as a big disappointment. I think this will be a year of fiscal drag. And that's, again, one of the cornerstones for why I'm more bullish on bonds than I am on stocks.
So if that's the surprise that bonds rally, inflation comes down more than expected, the Fed is able to cut rates, and one of the risks is that if we're wrong on the fiscal and they do pass through and they do spend more, then that bond calls that threat. Any other surprises or risks out there that you're thinking about or keeping an eye on?
Well, of course, there's all sorts of geopolitical risks as well. What's going to happen in terms of Iran? What sort of sanctions? How's that going to play out? The vacuum we see in Syria, and of course, the Mideast in general. How ultimately the Russia-Ukraine war gets resolved. China, Taiwan. There's it's not just the domestic policy backdrop between fiscal, immigration, tariff, and of course the Fed, domestic policy in general. We're in a bog of uncertainty right now. And look at the effect. We've gone from pricing in 9 rate cuts just a few months ago to basically almost nothing in short order. And this is all just because, to a large extent, Donald Trump getting elected in November. And then we have the geopolitics.
How are you feeling about Europe? A lot of people sound very bearish on Europe. Like Europe is a failed experiment. You see headlines like that all the time.
Well, and so there, but yet the European stock market outside of France had a phenomenal year. I mean, go figure that. We're talking about stock markets. The Euro stocks did well last year, and I agree. That's what I mean. It's not always about the fundamentals. This has been a momentum-driven market, globally. You have the bank. Japan was a great place to have money last year. Of course, you want to adjust for the currency, but you got a central bank, with its head in the sand. It's like a deer in the headlights to normalize interest rates, even in line with the rate of inflation. Japan, a great stock market last year, and Europe did just great with the economy flat in its back. But you're quite right. I think that I don't see where the growth impetus. There's actually the growth impetus in Europe is in what we used to call the pigs, right? And these pigs can fly. So what we're basket cases, the periphery of Europe is where the growth is, and core Europe, and mostly France and Germany are beset by huge political problems, and stagnant economies. And I guess you could also throw that maybe to a lesser extent over to the UK. Even in India, growth estimates there are coming down. I don't see where's the impetus? Everybody's raising their global GDP growth numbers for next year. I don't see where that's coming from. I guess it's really coming from because people think that Trump is going to get what he wants, that the U.S. economy has become miraculously impervious to the business cycle, and that Donald Trump is more powerful than Mother Nature, and that's basically what the belief system is. But I look around the world, and I can't find significant pockets of economic strength that would really matter from a global GDP standpoint. So I would tend to agree with you, and I would just say that, look, you're getting paid 4.5% to be in cash. And what if this turns out to be 2022? 2022, we had a big drawdown in the stock market, but rates were almost at zero. There's nowhere to go. There was no big safety valve. Now you got concerns over duration, which I understand. Donald Trump has created a bit of a problem for investors wanting to lengthen their bond duration. I get that. There's duration risk in bonds. And the stock market, despite, oh my God, all the talk, Santa rally here, Santa rally there, the stock market's done nothing for 3 months. But what makes this different, and the Fed seems to be moving to the sidelines, at least for now, is you're getting paid 4.5% to be in Treasury bills. And I know that's not exciting, but, my major theme for this year from an investment standpoint is a year, and this is what happens when you're in a bog of uncertainty. Bog of uncertainty, risk premia, in theory and in practice, risk premia should be going up. Ergo, the theme is preservation of capital and the preservation of cash flows. And so to borrow the, Simon and Garfunkel, it's a bridge over troubled water. And the troubled water's got a wooden snake in it. And I want to cross that bridge and turn more bullish in 2026.
That was exactly what I was going to ask you, is where do you wait? And it sounds like the answer is cash. Do you look at things like gold and hard assets? Is that an option as well?
Yeah, look, if I better understood Bitcoin to me is just gold with 20 times the volatility. It's a hard asset, but still secular bull on gold, absolutely. And I think that global aerospace defense should be a good place to be. Healthcare actually should be a good place to be as well, because that space is really cheapened up a lot. It's actually tied for third on our sector list. So it's not as if I'm not telling people, hey, go out and buy baked beans, canned tuna, and barbed wire and sawed-off shotguns. Okay, there's things you could do. We're secular bulls on Japan as well. If we want to play, we think like basically we're we are always looking at valuations, and they're not timing tools, but we're long-term investors, and we like valuation not as a timing device. That's what people, when the multiples are so crazy high, the pundits will come on TV and say, you can't use multiples. They're not a timing device. Okay, thanks. But for long-term investors, they're either the starting point on the multiple is a headwind or a tailwind. It'd be wonderful for me to think I'd love to invest in China, but there's too much geopolitical risk and too much concern I have over their lack of policy impetus. They seem to be thinking that they have carrying out policies to address the liquidity crisis when they actually have a solvency crisis. They're in a true classic balance sheet recession that's not going away. But if I want to play Asia, I certainly like Hong Kong, and we put out a buy recommendation in Hong Kong last spring. It turned out pretty well. So a lot of emerging Asia that we like, ex-China, we like Japan. Europe is cheap, but probably cheap for the right reason. And we're telling a lot of investors in the United States to start looking at Canada, which is trading at a historically massive multiple discount to the U.S. And it's a different market, but if you want to dip toes into the value trade, come to the TSX, because you're also going to pick up a currency that's dirt cheap. And in Canada, what's interesting is that there's going to be an election this year. It's a matter of timing. And we're going to have a conservative government that's going to usher in pro-business, pro-market-friendly policies. I don't think most people realize that outside of Canada itself. So there's areas to put money to work, but I would still say have a stash of cash, because I think that there's going to be some accidents that are going to happen. I think And a lot of the winners in the past year, I don't want to compare this to the dot-com crisis because it's not exactly the same. But I do think that there's going to be opportunities to put that money to work and you get paid for it. So whether it's 20 or 30% cash, I'm not going to say be 100%, but you want to have it. Put it this way, I don't think anybody will be hurt too badly mirroring what Warren Buffett has already done. 30% cash for it right now and getting paid for it in nominal and real terms, perfectly acceptable. But there's other things as well, right? And as I said before, I do believe that we're seeing a spasm or a hiccup in yields. I'm not freaking out over it. Again, I have the luxury of pontificating. I don't have to. I don't run money for a living. I don't have the temperament. But I could see that this is one of these hiccups and bond yield spasms that'll be a nice buying opportunity. I believe the global easing cycle is going to continue, even if the Fed pauses in January this month, which is likely. But I think as rates come down, what becomes scarce is yield. So when I say preservation of cash flows, where can you grab yield? And so there's different sectors. We're still bullish on utilities, for example, specifically because of the fact that dividend growth, dividend yield is an area of the stock market you'll want to participate in.
Fantastic stuff. David, it is always such a pleasure to catch up with you. Thank you so much.
It was great being back on, Maggie, and great seeing you again.